So if I can get every one of you to get to your seats. Thank you very much for moving forward. Thank you for going to your seats. We really appreciate it so we can get started on time. We're good. There you go. All right, if we can get the rest of you in the back to get your coffee and your drinks and get to your seats, we're going to get started in about 1 minute. We're just going to leave it right there.
We are.
Yeah.
Clarissa back in the chair. Thank you so much for coming. We're so glad to have you.
Okay, we're going to start. So if I get all of you to get to your seats, I'd really appreciate it. We're going to go a 30-second countdown. So if I can get you all to your seats, thank you. All right, it's starting to get quiet. Good morning. Okay, we do have a few seats still available, and we can bring in more chairs if necessary. Got 3 chairs up in front. All right. Well, it's getting quiet, so that must mean we're going to get ready to start. Well, first of all, good morning. Thank you for coming to the 26th Annual South County Economic Development Summit. Today promised to be full of information, fun, and even a surprise for you. My name is Dookie Valderrama. I'm a Port Commissioner for the Port of San Diego, and I'm also a board member of the South County EDC. And I'm proud that the Port is one of the golden sponsors for this event. I am joined today by Clarissa Falcon, who is also the chairman of the South County EDC, and I'm going to turn the event over to Clarissa at this given time.
Thank you, Dookie. Good morning, everyone. Thanks so much for joining us in this Friday morning. It is my honor to stand with Dookie as your co-host of this year's summit. The Economic Summit is made possible through the generosity of our sponsors. I would like to thank our title sponsor this morning, SCEDC, who are strong supporters of South County EDC and our economic development efforts. We are grateful for all they do throughout the region. Before we get started, let me all ask you to take out your phones and mobile devices. Yes, put them in silent, but please feel free to share what you're hearing at the summit. Feel free to post pictures and interesting things that you learn throughout the day. Now is actually a perfect opportunity to put that into practice as we announce our award winners for this year. If I could ask the representatives from our award sponsors, SDG&E, the City of Imperial Beach, U.S. Bank, MAC Project, Macmillan Companies, and Southwest Airlines to come stand just off the stage, and you will be joined by your awardees. This year, we had an exceptionally large amount of nominations for many noteworthy efforts. I want to commend all those nominated for doing such a great job in championing South County. Now, if I could ask the following award winners to join the sponsors off stage: Monica Montaño, Elizabeth Brown, Supervisor Greg Cox, Mayor Ron Morrison, Dr. Hamid Mani, Norma Hernandez, Dr. Francisco Escobedo, and Mary Lightcap. Right here to the side, please. Our first award is sponsored by SDG&E, presenting the Regional Leadership Award to my friend Monica Montaño of Scripps Health. Monica is everywhere. You can see her at South County EDC meetings, chamber events, Padres, Hispanic Council meetings, the Autism Tree events, Kiwanis, just to mention a few. And that's just on this side of the border, mind you. For leading the way in volunteerism and promoting South County throughout the region, SDG&E and South County EDC present Monica with the Regional Leadership Award. The Binational Award was sponsored by the City of Imperial Beach and is presented to the Cross Border Express. CBX, as it is known, is a historic project, literally bridging two countries to serve the needs of airline passengers on both sides of the border. For a groundbreaking project that took two countries to approve the permit and the efficiency in CBX operations, the City of Imperial Beach and South County EDC present the Binational Award to Elizabeth Brown at CBX. U.S. Bank sponsored the Outstanding Corporate Citizen Award, which is presented to Dr. Hamid Mani. Dr. Mani and his team run a free clinic on the weekends for uninsured residents of South County. At the eye clinic, patients are able to receive eye examinations, discuss treatment options free of charge. In addition, Dr. Mani has been an active supporter of many charitable and civic efforts in South County. For his generous donation of time and talent to underserved communities, Dr. Mani is named South County EDC and U.S. Bank's Outstanding Corporate Citizen of the Year.
I don't think there's a U.S. Bank representative. Ask them if they can run, if there's somebody here. Ask if the U.S. Bank representative is here.
Is there anyone from U.S. Bank here to present the award? Okay. The Corky McMillan Best of South County Award, since its inception, has been sponsored by the McMillan Company, and they are proud to present this award to Norma Hernandez. After a long career at Southwestern College, Norma retired as its president and superintendent. But her retirement didn't last long. Wanting to continue to make positive changes in the lives of Southwestern College students and faculty, she was elected twice to the Southwestern College Board. Her passion for education has found its way onto the San Diego Workforce Partnership Board and now currently serves as the chair of South County EDC's Workforce and Education Committee. Because of her commitment to our workforce and education, the Corky McMillan Best of South County Award is presented to Norma Hernandez. MAC Project is sponsoring the Pioneer Award, which is presented to Chula Vista Elementary School District and to Qualcomm. This award is shared between two very well-known entities for their collaboration on the Innovation Station located at the Chula Vista Library, which I've visited before, and it's such a really cool place, and they're really growing geniuses there. The station exposes students to the world of work and STEAM experience, STEAM meaning science, technology, engineering, arts, and math. For this unique partnership that benefits the future workforce of South County, the South County EDC and MAC Project present the Pioneer Award to Chula Vista Elementary School District, represented by Dr. Frankie Escobedo, and to Qualcomm, represented by Mary Lightcap.
This way over here more.
Yeah.
Okay.
Okay, maybe you're in the middle. Worse.
I don't know. Right here.
Okay.
The award. Awardee.
And finally, the Maryland Lastman Golden Dedication and Lifetime Achievement Award, sponsored by Southwest Airlines, is awarded to both County Supervisor Greg Cox and National City Mayor Ron Morrison, our local dynamic duos. The Maryland Lastman Golden Dedication Award is presented to two very well-known and loved people around South County. Whether talking about the Bayshore Bikeway or plans to South County's future, they are always part of the conversation. They are active members of the South County EDC and are part of our dignitary council. Collectively, they have served over 50 years as elected officials on behalf of their constituents for their dedication to the South County. Southwest Airlines and South County EDC present the Maryland Lastman Golden Dedication Lifetime Achievement Award to Mayor Ron Morrison and Supervisor Greg Cox.
Congratulations to all the winners and nominees. Please allow me to invite Ron Araujo from Mission Federal Credit Union to the stage. Ron is the president of Mission Federal Services, a wholly owned credit union service organization of Mission Federal Credit Union. Prior to being president, Ron was Mission Fed's CFO. He led the charge to bring assets of $2.9 billion and more than 194,000 customers. Ron brings over 25 years of leadership roles in the financial industry and will be sharing an economic overview. Please join me in welcoming Ron at this given time.
Well, good morning, everybody. Thank the council for having me here. As was mentioned, I was CFO with Mission Federal Credit for 8 years, so everything was kind of sailing along in San Diego and the economy and everything, and then I got there and everything wasn't sailing along and doing so good. But I don't associate those two things. Obviously, it's hard to look back and think that 2007 was 9 years ago, and I remember at the time discussions were about, oh, we're going to go into a 2-year recession and we'll pull right back out of it and everything will be fine. And then it really just kept grinding and grinding and grinding and just stayed on us. So, the last few years, definitely things have improved pretty dramatically. We're seeing kind of the last few years of just kind of tepid but positive growth. Nothing crazy, nothing outlandish. But when you look back, it might feel like this isn't kind of like maybe not everybody's participating, all regions are participating, but as we go through some slides here, you'll see that, for the most part, we're back to, for example, housing levels are back to where prices were back to where they were pre-recession. A lot of really good things, unemployment down. So it's not like it was back in like the early 2000s, but certainly there's a lot of good positive things out there right now. So I'm just going to share some information for 15 or 20 minutes. I've kind of given away my forecast, which is more of the same. But we can go through just some information, and then we have a panel here as well, and I know the panelists have some ideas and thoughts on this as well, so go ahead and get started here, if I can hit the right button. Okay, so we're looking now at comparing the markets from 2009 and 2016, and you can see, again, in March 2009, I don't think anybody expected that 7 years later we would have the Fed funds rate at 36 basis points or the 2-year or 10-year down at 150, but as a matter of fact, that's what we have. There's a lot of liquidity in the market. The central banks have continued to provide that liquidity. There's discussions about rate hikes. We did have a little rate hike previously, but there's no real material forecast out there that says, there's going to be this robust takeoff of interest rates and growth going forward. Non-farm payrolls, you'll see there. I have some more slides on that later on, but we continue to add jobs throughout the national economy and certainly in San Diego and in California as well. So things really are pretty positive. Some of the highlights here, obviously Brexit was the big summertime kind of surprise for everybody, and I think there's still going to be some fallout from that. There's still a lot of people trying to sort out how Great Britain and pulling out of the EU is going to sort itself out, but we did see a little bit of shock from that standpoint. So, does that create more political uncertainty throughout the globe? Potentially, but really nothing specific currently. So I'm kind of big on consumer confidence. I think that when consumers are a little bit more confident, we tend to see a pickup in their actual spending. And so this chart just actually relates those two. You can see in the blue, that's a matter of consumer confidence. That goes back to just right at the 2008, right at the thick of the Great Recession. And you can see confidence did drop, but it slow and steadily has picked up. It's kind of flattened out a little bit since then, and you can see that retail sales have kind of flattened out as well. That's certainly not to say that we're going to be seeing any sort of contraction in retail sales. I heard a forecast just a couple days ago that said, for example, that this holiday season, online spending is expected to be over 10% for the first time of total spending. So there's certainly spending going on out there. Again, good news, real good news. Automobile sales, one of the things that the company that I'm in, the subsidiary I'm in, is actively involved in automobile sales, and you can certainly see that there's a plateau taking place out there. This year, the projections are for 17.6 million vehicles to be sold nationwide. Next year, that's dropping down to about 17 million or so. So we are seeing a slowdown there. But there was a fair amount of pent-up demand for automobile sales built up over the last few years, as you can see. So even at 17 million, though, 17.6 this year is expected to be a record year. That will be a record year for auto sales. So still, 17 million next year is still a very good number. And I kind of talked about all of this already, consumer confidence and car sales. Home remodeling now is actually a big part of the market. We're doing much, for example, in the banking sector, credit unions and banking sector, we are seeing a lot of people taking out home equity loans and putting that money back into their property. my family and I are going through what I'm calling an unplanned remodel right now, which means that we actually had a floor leak downstairs, so we actually have to vacate for a month. But the workers there are saying, the companies are saying, it's hard to find people right now. So there is unemployment, a little bit of a restriction there, but again, jobs are out there, unemployment's low, there's economic activity, it's kind of more of the same. Home sales continue to look strong nationwide. I think this is the case for San Diego as well, and certainly for California. Home inventories, again, this is being a little constrained, and this is actually something that's playing into probably maybe one of the more challenging parts of the San Diego County economy right now, and that is actually rentals. And rent rates are at all-time highs right now. It is difficult to find rentable, affordable housing in some areas of the county. I think South County is probably a little bit better positioned than others from an affordability standpoint, but that is one area right now that is a little bit of a constraint. It's the availability of affordable rental housing. Average home prices, you go back to year over year, you see this growth. All of these areas, by the way, are higher than they were pre-Great Recession, and it's been that way for a few years now. So certainly that housing bubble we're past that completely at this point, and you can see that pretty much all areas are in fact participating. Median home prices for San Diego versus some of the other areas, you can see that there again. We'll have growth across the state. And there's some additional information on that. Sales, the second bullet point there, number of sales down on a year-over-year basis in California. Not real surprising. I think we're tailing off of, again, that peak that we had when there was a lot of activity. But there is a lack of supply issue out there. We work in Sereno Valley, our headquarters in Sereno Valley, and we still have a fair number of employees that are commuting in from the Temecula-Murrieta area because the affordability is there for them. So they're choosing to take a pretty long commute to get in. So the affordability on the coastal counties has been an issue for a long time and probably will continue to be an issue. But you're already seeing even the Inland Valley there. If you look at the fourth bullet point, even the Inland Valley is, there's some areas there that have not completely participated with respect to the housing bubble that took place. And that may not come back. There were some, if you go back to 2007, there was some really, really inflated housing prices inland in Riverside, San Bernardino areas in particular. Again, not a bubble, but we're not sure what will happen if we do see interest rates increase. A big part of our business right now in the credit union is in the refinance areas, and when you have 2.75% rates out there when people have equity in their homes, you're seeing a lot of refinance activity. That helps the affordability number to the extent that interest rates do go up, and I'm not predicting that interest rates are going to go up anytime soon, but to the extent that they do, that will work against affordability, and that could have an impact on home prices. But from my perspective, and I know that panelists will share their own thoughts, from my perspective, I think we're still a ways off on that, a few years out from something like that. So the economy as we know it, job growth has been solid. We continue, like I said, we're at about 150 to 200,000 nationally. San Diego is definitely participating in that as well. I think San Diego unemployment right now is probably around 5.5%. I think the state is probably about 5%. So we're in good shape from that perspective. Wage gains have been a little bit sticky, and that sort of average hourly wages. That's one of the things the Fed has looked at for the past few years. So the thinking being that while there are jobs being created, wages are not increasing, but we are seeing some pressure on wages now, so that's helpful because that increases household income, disposable income, which increases spending and kind of keeps the economy going as well. The housing season was good. It could have been better, but there really isn't much of a season anymore, realistically. I mean, it used to be the case, but now we tend to see pretty steady volume kind of throughout the year in San Diego. And inflation's ticking up a little bit by most measures, but again, I don't think anybody's going to be forecasting that we're going to get back to any sort of 3, 4, 5% inflation rates anytime soon. And business spending continues to be slow, which is one of the reasons that you see rates continuing to stay down. Rates are down because of the liquidity that the central bank, the Federal Reserve, is providing to the economy. That's not turned into as much borrowing activity by businesses. They're still a little bit careful out there. And it's not turned to as much borrowing activity by consumers either. So I'm projecting that to continue to kind of stay where it is. From an uncertainty perspective, let's see if I have another slide. We'll come back to the uncertainty aspect of it. So in spite of that, we continue to see interest rates declining here, as I mentioned earlier. Given where we are in the cycle right now, and given what we know about inflation, we would expect to see interest rates probably 1 to 1.5% higher. But again, with the central bank providing all that liquidity, it's really artificially keeping rates down. And again, in the hopes of spurring more business investment and activity in that area. And in spite of our low interest rates, from a relative standpoint, we actually look pretty good. The red up there is negative interest rates. I think people are aware of that at this point, that there is so much liquidity out there in the other parts of the world that we actually have negative interest rate environments out there. For Japan, they have been here since, well, not in negative territory, but they've had a low interest rate environment for, someone could correct me probably in this panel, probably 25 years or so. It's probably since the early 90s they've actually been in this. And that's one of the concerns, I think, for some forecasters for the United States, that at some point rates stay so low that we're not able to actually push rates back up, which is a good thing because that's a sign of economic activity. So that is probably one concern that's out there currently. But you can see from a relative standpoint, our 30 years at just over 2% right now. I think the 10 years 1.5% today. And you can see elsewhere you're talking about 5 basis points in Japan and a third of a percent in Germany. Again, this is just saying it just a little bit differently. Real rates, which would be including real rates, would not be including inflation. So a nominal rate includes the inflation piece there. Again, relative to other countries, rates are actually pretty high here right now. So this is really going to be kind of a global effort. The global economy is so intertwined at this point that it really is going to be a global effort to sort of get things back to where they need to be. Range of expectations. These are the 83 economists from Bloomberg 2016. I believe this was June. I'm not for sure, but it's not going to change. It wouldn't change much depending on which month it is. You can see the median forecast there, and you can see that it's, for the most part, with 83 economists, you get enough economists together and they still can't reach a conclusion. You've got the ranges all over the place. You see some contraction in GDP forecast down there at the bottom end, and then you see other areas where it's up at 4%. So no real consensus from that standpoint, but I do think if you look at the median, there is some central tendency around that in this forecast. So Fed funds, could we see Fed funds at 75 to 1% 1 year from now, which would be 2017? We could see some pickup in economic activity that would allow the Fed to actually raise interest rates. Again, and I bring this up because this is probably one of the main drivers of performance in San Diego, is going to be how well the national economy does and how well the state economy does as well. That's going to be a big driver for us. Small upticks in the 10-year, that's a big number because most mortgage activity is still priced off of the 10-year, so going from 1.5% to just over 2% as a forecast. So 3 different scenarios. I'm strongly in the consensus scenario here, but I do presentations and people want to see sort of what is out there on maybe not the extremes, but alternative scenarios that are out there. We'll stay with the low rate view, and that would just be that job growth falters. If we have economic contraction, we would definitely see that. With Asia and Europe continuing to just lag, that would drag down the global economy. That would have an impact on U.S. job creation. We would see commodities retreat, which would be great for that once a week when you're actually filling up your car, but not so good in other areas because that would portend a potential deflationary situation. That could be a real problem if we see a decline in inflation. That's one thing that the Fed is very much concerned about. We'll skip consensus for now, but go to the inflation case. If the Fed stays with rates, keeps rates too low too long, you see inflation surge, money supply, money velocity, all that stuff. I don't give a whole lot of I don't give a whole lot of credibility to that scenario just currently. It certainly is out there, but I think even when you look at the forecasts that we just looked at here, there's not a lot of buying on that. So consensus, and it probably sounds familiar, but it's really just consumers continue to boost spending, job growth continues to improve really slowly, and we avoid a crisis out of Brexit in the EU. We'll see a modest rise in interest rates and no global slowdown. Again, I'm a little stronger in that than, you'll have some other opinions here as well. I'm pretty strong in that camp currently. We've just seen so much of it. I think that's really where the expectations are built for consumers and probably for businesses as well. And then here would be the rate paths that kind of go along with that. And again, rate path 2, the red one there that you see, is probably where I'm set right now, but I could see someone making a case. I think a lot of things have to fall into place, but I could see somebody making the case for either of the other scenarios out there. 10-year note, same thing here. Kind of slow, steady increases there, maybe reflective of what happens with inflation, and then other rate paths out there as well. So to the Fed now, they've driven rates down now, and they've done, I think, what they've needed to do for the last probably 6 or 7 years, which is ensure that rates continue to stay low and create the opportunity for banks to lend, banks, credit unions, community banks, everybody to lend. So they're kind of they can't cut rates anymore. Theoretically they could, but they can't really cut rates anymore. So they're in a little bit of a kind of wait and hold pattern. If the economy does come to a halt, then there will be in a little bit of a box there. Again, I think that would be driven by the global economy, and I'm not forecasting that to happen. If the economy improves and inflation moves higher, bond rates could surge. This could potentially, could be cut, the economic improvement could be cut short if that leads to inflation and we see increases in interest rates. So we could be in a situation, stagflation, where we actually have constraints on economic growth and high interest rates as well. Those are both scenarios that are difficult for a Fed to kind of manage their way out of. But again, the general outlook is still good. Job growth remains steady. That's certainly the case for San Diego. Wage gains will become more of a story. Wage gains potentially could drive interest rates as well, could drive inflation, which eventually could drive interest rates up as well. To the extent that happens a little bit, that's really healthy for the economy. Again, if it gets out of hand, though, then it does become a little bit of a problem because it could choke off economic growth. There are some unknowns out there. I'm going to steer clear of the obvious one, which relates to the current presidential election. But there are other areas out there right now. There's some banking situations in Europe right now that the market's trying to manage. Some think that perhaps in some areas of the investment market, high yield bonds, for example, that there might be some bubbles building up in that area. But they're just going to be kind of like little obstacles along the way, I think. I don't think there's going to be anything really critical that comes out from that standpoint. Having said that, they are unknowns, and there are unknowns out there right now that people probably are not talking about. The Fed being on the sidelines until December, I think that's probably has to be the case now. It would be unlikely for the Fed to take any action prior to the election at this point. So I think if they do anything with respect to raising rates, it's going to be December at the very least. And that's it. So I want to just sort of lay the foundation here and kind of give my own thoughts on what's happened with the economy, but I know we're going to go to panel right now. So you want me to just lead that off? Or do we come in? Okay, terrific. So look forward to that part of it. Thank you. Get on with stuff.
Yeah. Thank you, Ron. That was great information. I'm going to break from script a little bit. First of all, I want to thank everybody that's here. I mean, we've got a great crowd, and you're all very special to the South County DC. But I really want to acknowledge two people that are out there. These people are here on the. Let me tell you who they are. First of all, it's High Tech High and Chula Vista Charter School. These students are here on their break. I think these are our future leaders. I want them all to stand, and I want to acknowledge them because it takes a lot for these kids to come here. This is our future. So thank you very much for being here today. Appreciate it. I know when I was in high school, you would have never caught me on my vacation being in an event like this, but thank you very much. As Ron indicated, we're going to take a deeper dive into the economic outlook, and I would like to invite the economic panel and moderator to the stage at this given time. There you are. Our moderator today is Nels Jansen with the San Diego Business Journal. Nels' supervision and all editorial coverage in addition to writing his own column. He joined the Journal in July of 2014. Previous to that, he was the editor and VP of the press enterprise. And he supervised coverage of the Dallas Cowboys' 3 Super Bowl victories. We've never got one here in San Diego. At the Dallas Morning News. Nels will introduce our panel today. Please join me in welcome Nels and the economic panel. Thank you.
Does that have the order of, I'm not sure whose slides come up first. It doesn't say.
No, it
Okay,
doesn't.
all right. Thank you very much. We have a great panel today, 3 economists who have experience not only in the public sector and the private sector. To my immediate left is Dr. Lynn Reeser, who is the chief economist at the Furmanian Business and Economic Institute at Point Loma Nazarene University. To her left is Eric Bruvold, who is the president of the National University System Institute for Policy Research. Both of these two do a lot of really cool projects, whether they're doing economic impact reports on the military or the impact of housing policies in the case of Lynn, or Eric, for example, does the annual craft beer economic report, which makes him a very popular person in San Diego County. And to his left is Ray Major, who's the chief economist for Sandag, and who also has considerable experience in the private sector. I don't know if many of you have ever heard of Claritas, very powerful demographic marketing tools, consumer behavior tools, and he was a key player in that. These folks have dedicated their careers to economic research. I do most of my economic research at Starbucks, but you learn interesting things. I mean, Ron mentioned the internet and the impact on sales. This morning I was at a Starbucks store and I asked the manager there, I said, okay, you started this mobile app order fairly recently, within I think it was the past year. What percentage of your orders now are coming in on a mobile order? And she said at that particular store, the low for any day was 9% and the high was 14%. Now, I find that astounding. To me, to change in behavior that quickly, but if you're not paying attention to changes in retail, you should be, because there's going to be all sorts of more dynamic, transformative changes in our economy, and I think consumer-facing retail is certainly going to be one of them. And I'm not actually sure, I believe we're starting the first presentation with Lynn. If we could get the next slide to see so we don't send up the next. Is that going to be me? Yes, it is. So I'm going to turn the stage over to Lynn Reeser from the Furmanian Business and Economic Institute at Point Loma. Lynn?
Thank you very much, and good morning to all of you. It's a real delight to be with this very outstanding panel. As Ron suggested, the progress of the world economy, the U.S. and California, will have a big impact on South County. So let me share with you my views of that overall picture. And I'm one of the 83 Bloomberg economists that he had in that slide, so I will give you my current views. So let me just briefly talk about the global U.S. California. And starting out with the global economy, there are really 4 major forces that are underway that are having a huge impact on us here in South County. First has been the situation of the rest of the world. In this chart, any number above 50 shows that more than half of the countries are expanding as opposed to contracting. So you can see we're above that 50 line, but not by much. So we're basically looking for, as Ron suggested, really slow growth among emerging countries, among advanced countries. The second big dynamic relates to something that we've never seen in our lifetime, and that is this swing towards low interest rates and even negative interest rates in countries such as Switzerland, Sweden, Germany at times, and Japan. And although this is supposed to help us, you look at Deutsche Bank today, I'm not sure it's going to be such a great windfall for everyone. The third major element that is important is oil prices. Saudi Arabia has basically been in a price war with U.S. shale producers. It's not clear who's winning here, but we saw oil prices drop below $30 a barrel early this year. Since then, they've sort of stabilizing between $40 and $50 a barrel. You might have heard chatter from OPEC saying they're going to try to freeze production, lower production. I'm a little skeptical. I think we're basically looking at oil prices probably pretty much in a range of $45 to $50 a barrel for the rest of this year. Good news for most of California because we generally consume energy, but certainly a big negative for our important trading partner to the south, Mexico. It's very dependent on petroleum. And to that point, here you can see the progress of the Mexican economy. Very strong in 2011 and 2012, but since then, in the last 3 years, we've basically seen a faltering growth, probably just somewhat over 2% in 2016. Which brings us to the fourth force that's driving us from the global perspective, and that's been the effect on exchange rates. The dollar has strengthened against most currencies, but currencies such as the Mexican peso have been hit very hard. The Mexican peso losing almost 1/3 of its value in just the last 2 years. Big boost to Mexican exports, but certainly devastating Mexicans on the border and affecting shopping coming on this side of the border in California. Still, South County is really benefiting from the growth we're seeing across the border with Mexico. We're seeing a very strong maquiladora industry, and we're also now benefiting greatly from the improvements in the flow of goods and services and people with the international airport in Tijuana and the developments at Otay 1 and Otay 2. Turning now to how California or the U.S. economy is doing, here's our balance sheet as we look at the drivers for the rest of the economy. Some good things going on, job gains, wages are starting actually to pick up again. Housing demand is very strong. State and local governments are seeing a windfall of tax revenues and property taxes, so keep paying your taxes. And the Fed still has the punch bowl out. By its own admission, it is accommodative, and it remains on that track. But there definitely are some significant headwinds. That sluggishness in the rest of the world, our strong dollar is really hurting our export potential and multinational U.S. companies. And the big long-term concern is lagging productivity. Economists aren't really quite sure why, but it's really a drag on our overall growth, and we see that year after year. We keep looking for better growth just around the corner, and I will admit to you, forecasters have been missed it year after year. We keep thinking next year's going to be better, and yet we just see about 2% growth. This year we had only 1% growth in the first half. It looks like the second half will be 3%, but guess what? What's that average to? Another year of 2%. So in terms of what companies are doing, as Ron suggested, they're not spending on new capital investment, but they still are hiring people. And we also see wages picking up. And so despite the feelings of most of us that we're always falling behind, actually most workers are staying ahead of inflation by a significant margin. And in fact, our Federal Reserve had been worried about inflation. We don't want inflation to be too hot, but we don't want it to be too cold. And it looks like it's trying to get back up towards that 2% target that the Fed would like to see. So in terms of the Federal Reserve, we were holding interest rates down at essentially zero all the way from 2008 to 2015. We got one tiny increase last December. We may get another Christmas present this year. And it looks like the Fed probably finally will give us that second rate increase in December of this year. But they've said things are going to be very gradual. We'll see. But right now we're looking for just this modest rise in rates, which will affect interest rates throughout the structure. So what does this mean for California? Well, despite the fears that we were going to sort of fall into the Pacific, California, in fact, rebounded, and it's rebounded very strongly. We will create about 400,000 jobs this year in California. In fact, not all the jobs are going to Texas. We're creating a lot of them here. And in fact, we've been outperforming the U.S. in terms of economic job growth year over year for 54 consecutive months. And that has not just been Silicon Valley, it's been widespread. In fact, today, 4 out of 5 metropolitan areas throughout California are outperforming the nation. We've also managed to see the unemployment rate come down. It was over 12% at the peak of the recession. Today, it's 5.5%, and I think over the next year, we'll be converging to about the national level of slightly below 5%. So in conclusion, in terms of the backdrop for the drivers for South County, from the global perspective, we're looking for sluggish growth, but no recession. Mexico will continue to be challenged, but it will offer tremendous opportunities in terms of expanded trade with South County. The U.S. economy, basically what I would say, it's plodding on. It's not going to be great growth, as Ron suggested, but no recession in the next year. The Fed is very cautious. They think there's a greater risk that they move too quickly than they don't move quickly enough. So they're going to make very certain that they have enough evidence, but we do think they will go for one rate increase this year. And finally, I think California will continue to outperform the U.S. South County will be benefiting from that outperformance and also will be a valuable contributor to that trend. Thank you very much.
Well, right. But yeah. Well, Ray will have better luck with the clicker than I will, so. Ray Major from Sandag.
Thank you very much. Good morning, everybody. I'd like to give a shout out to all the high school students. It's great that you're here. Don't let this discourage you from becoming economists. What I wanted to start out talking about a little bit is the transformation that's happened in the San Diego economy over the last 60 years. I know this is a talk about what's going to happen in 2017, but I think just from a historical perspective, it's very interesting to see how San Diego has evolved. When you take a look at the 1940s and you take a look at the composition of the economy, these bars show the number or the percentage of each one of the different employment sectors that we're tracking. So each bar represents 100%. And what you see in the 1940s, we had about 300,000 people over here pre-World War II. Military was definitely the largest employer that we had here in the region. Moving forward to 1960, you see that military became even larger. So when you hear about San Diego as a sleepy military town, it's because 34% of the people who were employed here in San Diego were employed directly by the military. Manufacturing at that point in time was about 15%, which is the bottom the second to the bottom pink bar, if you see it. The red bars kind of represent the traditional economy of retail, transportation, finance, insurance, construction. They're the ones that you hear about on the news all the time. When you take a look at the blue bars really represent what we've kind of deemed as the economic drivers here in San Diego, which are the innovation, the tourism, and the military sectors here. Healthcare, education, and government, I look at those as really the support sectors. Those are the ones that need to be in place to support a population of our size. Moving forward to 2000, what I just want to point out is that you see that things are starting to even out, okay? And there's a lot that goes behind this, but you can see how the economy is starting to shift. Moving forward to 2015, what you see is that we have a very diverse economy. About a third of it is in innovation, tourism, and military, okay? So those are the drivers of our economy. About 28% is really population driven, and that gives us about 61% of the economy, which during the last recession, the Great Recession, were actually recession resistant. So there are some phenomenal employers here in San Diego that really drive the economy. When you take a look at tourism, we're the #1 travel destination based on some estimates, and we have places like SeaWorld, Legoland, Balboa Park, a lot of synergy between these things to bring tourists here and leave dollars here. Innovation is big in San Diego with companies like Qualcomm and telecommunications. We have Illumina, which is revolutionizing the biotech industry, and we have a lot of cybersecurity. Anybody heard of any cybersecurity leaks or anything in the last couple of months? Okay, big industry coming in the future. Defense is also big here in San Diego. Okay, the interesting thing about this last recession is the amount of time that it took us to recover, and both Ron and Lynn talked a little bit about this, but an average cycle is about 2 years. It's about 11 and a half months in, and it's about 12.8 months out. That's the average since the 1940s. But when you take a look at this last recession, what happened was we were actually declining for 2 years, but it took us over 4 years to come out of this particular recession. That's a 76-month cycle. That was incredibly long, and I think that's why a lot of people feel, as Ron was mentioning, like they weren't getting ahead as much as they potentially would have liked to have. This is San Diego's total employment from 2000 to 2016. It covers the period of the Great Recession. You see that we peaked employment at about 1.35 million in December of '07, and we fell to a trough in January 2010, and then we recovered by June 14, okay? So in San Diego, our recovery was a little longer than the nation. It was 78 months. But we did finally recover from the recession. And as you can see, we've had some pretty good job gains since then, okay? But when we look at this from a sectorial perspective, so we take a look at what sectors are in the economy and what happened during this last recession, what you'll see is that the innovation sector, tourism, military, healthcare, education, and government were all resistant to this last recession. So they really kind of just grew right through there. So employment grew, and you can see that from the bars. The blue bars represent the 2007, green is the 2010 trough, and the orange bars are the 2015 peak, or when we recovered from it's actually now, most latest data, so when we recovered from the recession. If you look at the sectors that are susceptible to the recession, you'll see that it was retail trade, it was finance and insurance, it's construction, it was manufacturing and other services. Is that me? Pump up the bass. Okay, so the interesting thing here is, from a sectorial perspective, is that there are actually sectors that have not recovered. So if you look at, I got to put my economy face back on, right? Okay. Construction is not recovered from the recession over here. You'll see retail trade hasn't recovered either, and manufacturing is just now starting to recover. But these sectors were hit really hard. So if you were in the construction industry, you're still feeling it. When we take a look at wages and wages adjusted for inflation, it also shows a little bit of a different story. So this graph shows from 2004 to 2016, and what you see here is the median wage growth was 34% over that time period. The upper quartile of employees made 43%, the bottom 32% in terms of increases. But once you've corrected for inflation, what you see is a completely different story, okay? There was some increase over here, but look what's happened in the last 5 years. This orange line represents kind of the last 5 years, and what you'll see is that there hasn't been really any increase in real buying power, okay? And that's what people feel, is that prices, are going up on certain goods, rent is going up, but you're really not making that much more money. On the low end, the good news is that we've seen some rebound in the last couple years in terms of wages over here, but you can see that that it corrected for inflation, it's still lower than it was 5 years ago. Okay, this graph shows average wage by sector and job creation in San Diego from 2010 to 2015. So the green dots represent the sector. So this dot over here represents a sector that has right under 100,000 average income, and it has about 160,000 jobs in it, okay? So that's what this is showing. In 2010, the average wage in 2015 dollars was $56,100. So when we look at it, here are the sectors. You'll see innovation is up here, finance, insurance, professional government is over here, manufacturing, construction, healthcare, education, military, other services, tourism, trade, and transportation. I point those out because I know it's going to be hard to read in the back. Jobs up here are actually pay more than the median wage. Jobs down here pay less than the average wage. Every sector has recovered. Okay, there have been new jobs in every sector. You see 24,600 in healthcare, 15,900 in construction. So that's great news. We added 130,000 jobs during that time period. But when we take a look at the average wages over the time period too, what you'll see is that many of the sectors have decreased in terms of average wages. Only manufacturing and innovation really have made any type of increase in wages. We have tourism that went up $200 per year over that time period. But otherwise, every one of the sectors has actually had a decrease. So now the average wage for these jobs is $55,300. In the last 5 years, the job creation in San Diego, about 30% of the jobs were in those industries that had above average wages, 70% were below. Now, this is a problem nationwide, but this is how it manifests itself in San Diego. Our housing market remains tight. If you take a look at the permits that were issued, you'll see that during the recession there were very few permits issued. We're back to a point where we're building about an average number of permits, but there is a pent-up demand for additional housing. And what you'll see in terms of housing prices, that they peaked in June 2006, they fell to the bottom in May 2009, and we're back at about where we were in June 2007. When you look at the affordability index of these homes, what you'll see here at the bottom, or at the peak of the housing market, about 9% of the people were able to afford homes. That fell to 46% at the bottom of the recession. We're at about 25% right now, which is kind of average for San Diego. The big difference between these 2 points here is the interest rates. Over here, we're looking at sub 3% interest rates. Over here, we have more than 6% interest rates, and that's really what drives people's ability to afford housing. There's a housing problem in all urban areas in the United States, but in San Diego, we also feel it. This is kind of how it plays out. The median price home is about $495,000 in San Diego. You would need dual income of $62,000 in order to afford the mortgage on that particular house, given the current interest rates. The average income of $55,000, if you were living by yourself, you would be able to afford a house of about $232,000. And if you had a dual income of the average wage for 2015, you'd be able to afford a house of about $433,000. So you see that affordability is a problem here in the San Diego region. Looking forward, in terms of forecast, what I see is in 2017 that those sectors that we consider to be drivers in the economy, the innovation sector will continue to thrive. Travel and hospitality will also outpace GDP, and military is going to continue to expand as the Pacific Pivot brings more ships here to the San Diego region. In terms of population-driven sectors, healthcare is going to continue to grow, especially as the population ages and home health care grows. Education remains stable, and government will really just grow with the population. Other sectors in the San Diego economy, look at retail trade. The outlook looks a little bit weak there in terms of retail trade. A lot of this has to do with people buying things on the internet and that not creating jobs over here. Financial and professional is expected to grow very slowly. Construction and real estate, in terms of the traditional economy, is really the strong point within that economy. I think it continues to grow for the next couple of years. And manufacturing continues a steady but slow recovery. So with that, I think we really need to have optimism despite our challenges. The economy here in San Diego has a tremendous amount of strengths. We have a diversified economy, a highly capable workforce, and a really good framework to provide good jobs in the region. There are challenges nationally and at the state level, and also locally in terms of job creation. And I think that the outlook overall for San Diego is relatively bright. We have a resilient economy. As Dr. Reesner pointed out, we have low unemployment rates, continued job growth, the positive outlook for the very key sectors in the economy, and the housing market has finally recovered, and there's a big revitalization of the urban core going on. So thank you very much.